Hi, everyone, and welcome back to Financial Market Insights for Traders. I'm Sophia, and today we are going to talk about something that doesn't always get the attention it deserves, but honestly, it should. We are talking about cash. More specifically, how much cash you should be holding in 2026, and why understanding cash allocation in macro cycles might be one of the most important things you do as an investor or trader right now. Because here's the thing. For years, cash was treated like a passive decision, almost like doing nothing. You either invested your money or you left it sitting there. And if it was sitting there, people assumed you were missing out. But that view doesn't really hold up anymore. In 2026, cash is no longer just a safety net. It's a strategic tool. And if you use it properly, it can give you flexibility, clarity, and real advantage in markets that are becoming more unpredictable by the year. So let's break this down properly. Why cash actually matters again. Let's start with a simple shift that's happened over the past few years. We are no longer in a zero interest rate world. Cash isn't earning nothing anymore. Depending on where you're holding it, you might be getting 3, 4, even 5%. That changes the equation completely. Because now, cash does three very important things at the same time. First, it gives you liquidity. You can act quickly when opportunities show up. Second, it gives you stability. It reduces the volatility of your portfolio, especially during rough periods. And third, and this is probably the most important, it gives you optionality. Optionality means you're not forced into decisions. You're not scrambling to sell assets when markets drop. You're in a position to wait, observe, and act when the timing makes sense. And in uncertain macro environments, that's incredibly valuable. Understanding cash allocation in macro cycles. Now, if you take one idea from this episode, let it be this. There is no fixed percentage of cash that works all the time. The right level of cash depends on where we are in the broader economic cycle. That's what we mean when we talk about cash allocation in macro cycles. So let's walk through those cycles in a bit more depth. Late cycle, when things start tightening. This is the phase where central banks are either raising interest rates or holding them at elevated levels to deal with inflation. You'll usually see borrowing costs rising, asset valuations starting to come under pressure, and economic growth beginning to slow. In this phase, increasing your cash allocation makes sense. We are typically talking about somewhere in the 15 to 30% range. And the reason is simple. Both stocks and bonds can struggle here. Meanwhile, cash starts to look more attractive because it's actually earning something. Volatility tends to increase, and having liquidity gives you breathing room. So holding more cash in this phase isn't about being defensive. It's about being realistic. Recession or contraction, the uncomfortable phase. This is where things get more difficult. You'll see earnings decline, layoffs increase, and overall sentiment turn negative. Markets can become very volatile, and headlines are usually not encouraging. In this environment, cash becomes incredibly powerful. We are looking at a range of roughly 20 to 40%. Now, this is where many investors struggle emotionally, because everything feels uncertain. But experienced investors understand that this is also where opportunities begin to form. If you have cash during this phase, you're not panicking. You're preparing. Because historically, the best buying opportunities don't show up when things feel safe. They show up when things feel uncomfortable. Early recovery, the turning point most people miss. This phase is subtle, and it often catches people off guard. The data still looks weak. The headlines might still be negative, but markets begin to move higher. Central banks may start easing. Liquidity improves. Risk appetite starts to return. In this phase, holding too much cash can actually hurt you. A reasonable range here is around 10 to 20%. And this is where timing becomes tricky. Because if you wait for everything to look good again, you'll likely miss a large part of the move. Markets tend to recover before the economy looks healthy on paper. Expansion, when everything feels easy. This is the phase people are most comfortable with. Strong growth, rising earnings, positive sentiment. In this environment, cash allocation is typically lower, around 5 to 10%. Because this is when capital should be working. Cash still has a role, but it's more of a buffer than a core position. So where are we in 2026? Now, here's where things get interesting. 2026 doesn't fit neatly into one of these categories. Instead, we are in a kind of mixed or transitional environment. Inflation has come down, but it's not fully stable. Interest rates are still relatively high compared to the previous decade. Growth is uneven depending on the region, and markets are reacting quickly to macro data. So what does that mean? It means flexibility matters more than ever. For most investors, a reasonable baseline is somewhere between 10 and 25% in cash. But the key isn't the exact number. The key is your ability to adjust it over time. Static vs dynamic cash allocation. A lot of people set a fixed percentage and stick with it. That's simple, but it's not always effective in today's environment. A static approach might mean always holding, say, 10% cash regardless of what's happening in the market. A dynamic approach is different. You increase cash when uncertainty rises. You reduce it when opportunities appear. This aligns much more closely with the idea of cash allocation in macro cycles. You don't need to get every move right. You just need to stay responsive. Personal factors still matter. Now, even with all this macro context, your personal situation still plays a big role. Let's go through a few key factors. Your time horizon matters a lot. If you're investing for the long term, say 10 years or more, you can generally afford to hold less cash. If you need access to your money in the near term, cash becomes more important. Your risk tolerance matters too. Some people are comfortable with volatility. Others prefer stability. There's no right answer here, but your cash level should reflect what you can actually stick with. And then there's income stability. If your income is consistent, you can take more risk. If it's uncertain, having a larger cash buffer can provide peace of mind. The hidden cost of holding too much cash. Now, let's talk about the other side of the equation. Cash feels safe, but it's not free. If markets are returning, say, 8% over time, and your cash is earning 4%, holding too much cash will drag down your overall returns. And over long periods, that difference compounds. So again, this comes back to balance. Cash allocation in macro cycles isn't about maximizing safety. It's about positioning yourself effectively, making your cash work. If you are holding cash, make sure it's actually working for you. That might mean using high-yield savings accounts, money market funds, treasury bills, or short-duration government bonds. These options allow you to earn a return while keeping your money accessible. Using cash as a tactical tool. The most effective investors don't just hold cash. They use it actively. They build cash positions when markets are stretched. They deploy cash during corrections. They stay patient when others rush. And to do this well, you need visibility. You need tools that help you understand what's happening in the market in real time. If you're looking for a world-class, cutting-edge, user-friendly trading platform, I'd recommend checking out this platform at crystalballmarkets.com/platform. It's designed to help you navigate market cycles with more clarity, which makes decisions around cash much easier. Keep learning the bigger picture. Understanding macro cycles takes time. If you want to build that understanding step by step, I'd suggest listening to this podcast at rss.com/podcast/crystalballmarkets. It's very beginner friendly and covers trading, investing, and macro trends in a way that's easy to follow and actually useful. Common mistakes to watch out for. Before we wrap up, let's quickly go through a few mistakes that still show up again and again. Holding zero cash is one of them. It limits your flexibility and increases your risk. Holding too much cash out of fear is another. That often leads to underperformance. Reacting too late is also common. If you adjust your cash position after markets have already moved, you're playing catch up. And finally, ignoring the macro environment. Your cash decisions should reflect what's happening in the bigger picture. A simple framework you can use. If you want something practical to take away from this episode, here's a simple approach. Start with around 15 to 20% cash. If markets look stretched or uncertainty increases, move toward 25 to 30%. If markets correct and opportunities appear, reduce toward 10 to 15% and review your position every few months. It doesn't have to be complicated. Final thoughts. Cash is no longer just a passive part of your portfolio. In 2026, it's one of the most flexible and useful tools you have. Understanding cash allocation in macro cycles helps you stay prepared, stay disciplined, and make better decisions over time. You don't need perfect timing. You don't need to predict everything. You just need to stay away, stay flexible, and be ready to act when it matters. Because in today's markets, the real advantage isn't always being fully invested. It's being ready. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.